They're on pace to do over 400 billion in revenue this year. So I built a tremendous amount of safety. The company's doing everything I could possibly ask them to do. That's paying dividends, that's buying back stock, that's growing top line revenue, and that's bringing it down to EPS and cash flows. Welcome in, ladies and gentlemen. So my phone has been blowing up and I've been getting messages on a company called PAYCOM Software. This is a payroll/human resources technology platform that was growing extremely fast, and everything about the fundamentals in this company was very strong here. We can see that it is down 39%, and I'm sure a lot of people are freaking out, so I definitely want to get to this one. It is announcing a dividend for November 24th, and so I have done an analysis on this one, so we're going to figure out what exactly is going on here. Along with that, CVS did report as well. Once again, this one's selling off. We're going to do an update on that one, although I think CVS's sell-off is possibly going to be an opportunity because they're really just guiding down slightly. PAYCOM, we got to dig into. So if you're new to the channel, you know what to do. Now, PAYCOM is only a $14 billion market cap. With these types of companies, lower floats, lower market caps, volatility is absolutely going to be there. So, you could see your positions down 20, 30, maybe even 40%. And sometimes you just have to ignore the noise as long as it's nothing fundamentally wrong with the company. So PAYCOM did have a slight miss on revenues, did beat EPS pretty strong here. And the revenue guidance is where the problem is going to come in here. Because when we're projecting out very strong growth rates, anytime there's a speed bump here, you get these massive pullbacks. And there's going to be other companies that this is going to happen to that I've talked about on the channel that people still want to buy. But when earnings come up, earnings are going to be the true tale here. Now, this is a company that I thought could project out what they were going to do. And we're also seeing free cash flow being a problem here as well. Gross margins are coming down. And when we see the margins starting to get compressed, there's multiple headwinds we're seeing with the stock, but a lot of times people are selling first, asking questions later. Well, this is a pretty sad earnings call overall because of the misses. They're not, to me, I feel like how much it's down could be overblown here, but we're going to start plugging in these numbers and figuring that out. I mean, the stock is down 40%. This seems really overdone, but so I'm building some safety here, projecting out that they're going to do right around a little over $1.6 billion in 2024, which we all know that they can possibly do. We brought the growth rates down from 22% down to 17%, and by 2032 they're doing right around $4 billion of top line revenue, and putting a little bit of dilution in here as well, so there is shares being issued while we're doing these numbers. So I get two different numbers here. I get a free cash flow number, and I also get a multiple of enterprise value to EBITDA. Now, if this company was growing over 20%, I definitely lean towards the EBITDA value versus the free cash flow value, because it's just too hard to project out what true free cash flow is going to be. Now, I also want to reiterate that we did have right around a $200 to $220 price target on this stock, but now that growth rates have went from basically your mid 20s down to 15, 16, 17% growth rates, it's a substantial decline when we project that out over the next 7 to 8 years. We also projected out margins shrinking and free cash flow shrinking. So not only are we bringing the growth rates down a substantial amount, but we're also projecting out free cash flow to be a little bit weaker and margins to be a little bit weaker. So all these combined is definitely going to impact the price. And so we go from basically a $200 to $220 stock plus $172.50. That comes out to $254.25. We divide that by 2. We get right around $125 to $130 price target. I'm putting a double-digit rate of return in that. So by 2032, I do think the stock is probably going to be worth anywhere from $275 to probably closer to $300 a share. But in order for me to get a double-digit rate of return, I need to be buying the stock right around that 135 mark. And we can see the stock is trading at 148. What I want everybody to understand, this is a Now what I want everybody to understand, this is a story I'm telling off of today's news, okay? Do you think that the company can outperform 17% growth rates, and do you think they can get margins back? Because if the answer is yes, then I think the stock is absolutely a buy today. So maybe you don't think they can do, maybe you think they can do a little over 15, 16% growth rates and probably closer to that 20% growth rates. I think the buy is today. If you think they're going to do closer to mid and high teen growth rates, then I think you want to wait until that 135, maybe 140 mark. So CVS is now down right around 4 to 5%. They did beat on top and bottom line. One of the areas I do want to highlight is that pharmacy and consumer sales were up 6% to 28.8 billion. And and this is where there's some hidden value with the company, because a lot of people are writing off the pharmacy side. And while Amazon is getting into the field, it's going to be another year or two before it really starts to come to fruition. CVS and Walgreens basically own this space. And when we think about all these diet drugs that are coming out, and all these new prescriptions and new cures that are coming out, CVS is going to definitely benefit from this. Adjusted earnings are coming in right around $8.50 to $8.70. And they are still guiding for pretty good free cash flow here, $12.5 to $13.5 billion of free cash flow. When I buy a stock, I like the free cash flow to be under 10 times their market cap. Market cap on CVS is $88 billion. They're doing $13.5 billion of free cash flow on the high end. They also did $89 billion of sales in the quarter. So 1/4 of sales is equivalent to what their market cap is, and their ability to get strong free cash flow, to me, still makes this a pretty interesting value play. I mean, so when we look at revenue here, revenue coming in $238 billion last year in the 9 months ending versus $263 billion on the 9 months ending. So great top line revenue growth here for a company that's going to do over $300 billion of revenue. Last year in the same quarter, they did $81 billion in revenue. This quarter, they're almost pushing $90 billion of revenue. That's nearly a 10% gain. Look at operating income. Operating income was $4.2 billion last year. It was $4.2 billion last year in the 9 months ending, now at $10.3 billion. And from a GAAP perspective, they were earning $1.50 last year, now earning almost $5 a share, but yet the stock price is 35% off. And so this is the disconnect that I'm really seeing with this company. We're running down the fundamentals here, and yes, the fundamentals are getting stronger. What the market is doing right now is the company did guide down to the lower end of their guidance, which is a few cents below analyst expectations. From a GAAP perspective, they're going to do anywhere between $6.50 a share to right around $7 a share. The company is trading right around $65, which means this is less than 10 times earnings, but we can see here that the growth rates are pushing 10%. So this is falling into a PEG ratio right around 1. The company has strong free cash flow. I'm not seeing any major problems with this company. And so these types of sell-offs to me are definitely opportunities. The question is this: how much market share is Amazon going to take if Amazon does get into the field? There's a huge liability here for not going into a physical store, talking to a true pharmacist, and being prescribed on how to take a medication. So to me, this is getting pretty blown out, and I think this could be an opportunity. I could be completely wrong here. Now, my ideal price target for CVS is right around $60 a share. They are growing well above 4%, 2%, and 2%. But I am erring on caution here. By the end of 2024, I have them doing $345 billion of revenue. But when we look at their quarterly report, they're on pace to do over $400 billion in revenue this year. So I built a tremendous amount of safety. The company's doing everything I could possibly ask them to do. That's paying dividends, that's buying back stock, that's growing top line revenue, and that's bringing it down to EPS and cash flows. So for me, this is still a buy, guys, and I'm very convicted on this play. As always, appreciate your time. Thank you for spending it with me.